Hi, everyone. As you can see from the screen, I'm going to be discussing the whole subject around emotions and making sure we don't let those emotions control our trading. Sounds a lot easier than it actually is, but hopefully over the next few slides, I can walk you through understanding why it potentially is a problem and hoping I can help you solve it as well. So what are we talking about? Well, markets are tough right now. We have lots of volatility. And, as in life, we're going to find we have lots of high points and low points during our trading. We simply are not robots. So we are going to have good and bad emotions coming through in our trading day. And it's how we deal with those that will help us in our trading. Key thing is we are in a high volatile environment, and these emotions will get heightened as markets move quicker and some of the numbers get bigger. Our profits and our losses can get bigger, and we need to be able to cope with that. The issue is we generally start making poorer decisions when this volatility comes. And, we've got to be able to change that and make sure that we're always on top of what we do. If I can give an example here, I've got an oil chart, a 1 hour oil chart, just at the beginning of September. And, the first patch in blue, we effectively create a 4% trading range. Now, that in itself for oil is a reasonable range, and it will provide opportunity for us. But as you see, in those 2 days, we go from the highs created up there at 89.61, we move down to 85.97 in pretty quick time, and we get a bounce very rapidly all the way back up to the highs. And not only do we get that, we then see a reversal back down close to the lows. And this in itself is part of volatility. These reversals are quick, they're very tough. Whether you're a bull or a bear in this environment, it's very, very tough to either keep hold of your positions or find the exact places to be taking profits or indeed your stop losses. And then as we move just another couple of days further forward, the situation gets even worse. These ranges move out to about 6% as we have a false break on the top and immediately reverse back down for a false break on the low. And again, no matter which way you are in this market, these are very, very tough to handle. And our emotions are going to get heightened in these situations because we could go to situations where we've got a nice profit and all of a sudden it gets taken away from us. So we've got to be able to adapt and trade within this style of market to keep our balance sheet high. The situation gets even worse because we do finally get a break, and it's a break to the downside. But as we find a new low, we get a nice quick reversal back up to the former base. And overall, we've got a 10% range in a matter of 4 or 5 trading days. So very, very difficult for us to navigate these waters. How do we get through this? Well, the first key thing is to understand our markets. What we've got here is a mixture of headlines governing the markets, but you see the reversals that we get. Some of those come through sentiment, over positioning, where in first instance, all red headlines for us are things that would send the market lower, and the green ones force the reversals and the market bounces. Yes, you could say we have an overall downward trend, but even if you were a bear in this, it's very, very tough to keep hold of some of your positions. So we need to really go into the detail and be alert enough to understand what causes some of these moves. We need to understand the product we're in, and that's all part of our process. And that is the key to helping us survive when our emotions get heightened during these volatile periods. We need a solid process underlying what we do to help us get through. So we need to understand, in this instance, recession fears, lower demand should potentially send oil lower. And in this instance, there was a cap on Russian oil. But when that was announced, there was a counter argument coming through into the market. And that's what caused it to bounce, because the market had clearly got itself short. And then the slightest positive news for the oil price turned everything higher. But that was caused by a production cut. Less oil around, the higher the price. But when the details of that came out, it was only a token effort of 100,000 barrels, certainly not enough to keep inflating oil price. So we turn again as negativity comes back into global demand. China continues to lock down. And again, as we go through, we get false breaks because we get some comments from Putin. But eventually we do get that downward move. But you see these subtle differences in headlines. We need to be very, very sharp and monitoring this all the time to be able to continue to navigate these markets. So attention to detail is critical. What am I talking about when I talk about good and bad emotions? Well, to me, they are equally divisive. Don't feel a good emotion, being happy will help you survive markets. But sometimes if you're too happy, you think the markets are easy and you can't handle when the markets go against you. But, there's a mixture here. None of them relate to the exact point on the chart that you see. But if I could just take a couple there, you've got aggressive there. Sometimes for me, it's good to be aggressive. If you're in a nice position, the market's going in your favor and you're courageous enough and aggressive enough to add leverage in that move, that's a good thing. The problem is if you're doing it because you're angry, because you feel the market's taking money away from you, and you start with your aggressive nature, over trading because you're trying to get your money back, you're chasing every headline, chasing every shadow in the market, then what you've basically done is, instead of using aggression as an edge, you've moved so far one way that it's going to be divisive for you. So the key message from this slide, no matter which one of these you look at, is you have to be aware of the behavioral responses for when these emotions move to the extremes. So our job is to stop our emotions moving to these extremes. And the only way I can offer you help on that is to go back to your process. And as you've seen on some slides before that we've shown you, we have a process wheel that we believe will put you in good footing for your trading into the future. It's a continuous wheel, as you see for the arrow, because markets don't stop, and nor should the hard work and disciplines that we put into our trading. In brief, this is all method. And what we want to get to is making sure that 80% of what we do is method. It's our formula. It's an underlying formula that we can tweak from time to time as we evaluate our trades and our process to basically help us understand what we did right and keep doing that. And on the things that we do wrong, we have a quick review, not a post-mortem, and we can maybe tweak that and help us going forward with our trading. Let's not make the same mistakes twice. So simply here, we're creating ideas. We have attention to detail as we create those ideas. We have all the indicators on our desk to make sure that if a correlated market starts moving against our ideas, it may be that little pointer for us to have a bit more attention to what we're doing in our markets and possibly get out or add leverage if that correlated market is actually telling us that there's continuation elsewhere in the market of our theme. Another key one there, and this really does help you in your process, and it will help you with your emotions as well, the assignation of risk. Make sure you only have the correct amount of risk, firstly, that you as an individual can handle. We all have different mental capacity for losses and sizes of market risk. And the other key thing is it's a confidence factor, and it's also maybe the track record and also the product that we're in. So make sure you assign the right level of risk, and that will really help you, because there's nothing worse than trying to make a good decision, particularly when a market's going against you and you have too much risk in it. So lots of detail on that one, please. And the rest is, how your trading style, how you put orders in the market, how you use those market functionality to get in and out of trades. The other 20%, as you'll see there, I've left as psychology. Number one, because we cannot eradicate it. We're human beings. It will always be there. Number two, because I believe we should always have a bit of flair in our trading. It's our own DNA, our own instinct, our gut feel that will help us differentiate ourselves from the rest of the market participants and hopefully give us that little bit of edge to take a little bit more money out of the market. So no silver bullet apart from when markets get tough, go back to your process, believe in your process, have confidence in what you're doing. And again, try and stop those emotions moving to the extremes. If you feel they are, then maybe it's time to back off from the market for a short period, long period, however it takes for you to decompress. And then when you come back into the marketplace, lower your risk, dip your toe in the water, and off you go again on your trading. Hopefully that helps. Good luck with your future trading, and I'll see you again in a couple of weeks.